Hello and welcome everyone to the weekly Delphian meeting. Thank you for attending. So we will, our agenda for today, we're going to do, we're going to mute everyone first. And then we're going to go through, I'll go through a market update. And I put together a little something as far as market pulse. So we'll go through that. And then, Shawn's going to go through earnings trades, tracking some of those trades and just kind of overall how they've been going. Obviously, we'll open up to questions also for people. So without further ado, let's get started. So, just in general, we've seen our state ones drop, from the low 70s. We had a pretty significant drop there. Still get people joining. So, we got a high of 73. So we had a pretty significant drop in state ones, not so much any pickup in the state eights there. So, we'll have to see kind of how things, that kind of went along with how the market moved. Had a little dip and then, it's kind of been slowly building back. Last week, I think, that was Tuesday where we talked. So we saw it, at least for the SPX, still in state one, well over a time frame, average move well above all those stats over here. So back in end of December, you can see once it broke above 3 and, tested 3, that turned into support. So it ran up, kept going. So we got that high on January 26th. That was, the last data point we were looking at. So since then it's tipped over and it tested target 3 again, right? And it bounced off. So, so really what we're looking at, we have a specific range we're looking for here. So, is it going to make all-time highs again, or is it going to go down and test 3? So if it tests 3 and breaks through, then I think that'd be, the impetus for it, to transition to state 2. Now I can't predict that, but, just from what I've seen over time, when it does cross below T3 after a move like this, it would go to 2. And then we can kind of plan out things from there. The Russell is still up in la la land, but these are the 2 key levels I'd be looking at. Target 3, if it does make another run down there, is it gonna close and hold below that level? And then, can we get above highs? So that's a range that we're looking at specifically for SPX. Russell's way off. So we'll just we'll look at NDX too, real quick. So NDX mirrored, same thing, from last week, went down, actually closed below that 3 and then, popped right above it. So, we're looking for, things that hold below that T3 and, we'll decide, it's pretty much the mirror of SPX. So, so that's what, we can look for that. So what I wanted to do, those key levels, target 3 and the new highs. So you have 2 indices you can kind of watch on that. So what I want to do, I prepared a quick little slideshow. I didn't jazz it all up. This is kind of, bare bones. So what I want to do is just kind of go through some market drop analysis so I was mostly using market pulse. And then I also was looking at lower lows. So, we're going to go through, there's 4 different kind of data points: spring 2020, fall 18, summer 16, and then spring 10. So this is the market pulse back in right before Corona really took hold. So we had that state 1 and state 8. So that's what this chart is showing. So that's basically our cross day was the 25th. So if we look at when that happened, actually on the SPX chart, this is our crossover day here. So it was a pretty good warning as far as that indicator on this. Now we'll see kind of as we go through these other ones, how well it does as far as triggering, be cautious type thing. Market could fall. So what I also, I'm always looking for new things that can kind of help as far as, figuring out, market analysis type of thing. So the low lows, the new lows, I found to be pretty useful, and that's kind of why, that's the majority of what I want to present here to kind of get you guys on board with this. So you can see, the 25th here, when we had a crossover, we had a big spike. So I kind of just call this the flat line where, you're barely, making any new low lows and, flat line here. Then you had a dramatic spike up, the 25th, right, which coincided with that crossover of 1 to 2, 1 and 8, excuse me. So we weren't super high, but this was probably about 40. The average highs like 45 or so. Obviously not like we were at 72 here, like last week. But that's kind of like the normal highs as far as state ones. So those crossed over, and you had a big spike. So it pretty much coincided, and then you had this pretty good move down, and I think the market, you can use market pulse to confirm things, obviously it just kind of had a nice big spike here, and then you had these big spikes with the new lows. So I think those two things together can give you a pretty good indication things are getting crazy in the market. And we'll show more examples of that, but I also want to point out here, right down here, I just called that the low lows flat lines. So on that chart, it's kind of like a VIX type of thing where, we just go back to the normal level, right? So we're down here, little bumps in the road here, not anything like, this is usually under 100, new lows. Then you get these dramatic spikes up, and that's just, where the market really moves, that and, the market pulse turning. So that was the spring. You can see like the all clear, was here for the low lows. And then, you're getting confirmation, that was kind of near the top here. And then everything turned, and, it was the state eights were dropping pretty significantly after that. So, and you got to cross here in May. So that May cross wasn't even until here, but you got the flat line here. But it was the market pulse was working its way back. So so all of these kind of little dips are a little different, but I just kind of wanted to show you the analysis for each one of these. All right, so let's go into the fall of 18. So we had a crossover, not dramatic until, here in October, but you did have the 8 and 1 crossover. They were kind of going back and forth beforehand. I just took this as the beginning here, September 18. So obviously before anything occurred. All right, we keep getting more people joining. Obviously, a little bit before things got wonky in the market, I labeled the flat line down there too. So this is kind of where, I think this new lows is going to really help. So, we're still pretty much some, pretty flat line back then until you can see at the beginning, beginning part of October, things started really ramping up fast as far as the new lows. Um, and that pretty much coincides with right when things really started turning. So, and, the state aids were holding steady, growing throughout that time period. So I think, using these two things together, for the most part, it's going to give you a really good indication of when things are gonna, because that's what we're really trying to guard against. Because most of our bets are bullish, is these big drops quickly. And there's a lot of momentum, and it's, you got to, I think at this point, see the new lows really spike up. It's like, and they have these like confirmation, as far as the market pulse, things getting weaker in the market, the eights getting higher in percentages and ones dropping. So this was the flat line here. You can see the cliff, and then it just goes dead, the like no heartbeat here. And that's in January. So you can see January, here's the big drop, and then it confirms when it does cross over here. So this would be, if you're pretty, I guess the whole thing with the lows is, you could try, and if you really want to jump the gun, you could get caught here in these kind of valleys. During that time period, it seemed like, we're still climbing. So, you want to see things roll over, ones, kind of getting stronger, these things moving towards each other. And really just that, I mean, this is a flat line, it's just, that's pretty much the all clear, and you just want to kind of watch how things turn after that. So that all clear kind of came right here, and then from there it's just straight line down, and that's the all clear on the new lows. So I think those two things together obviously show pretty good indications as far as these, when the markets get turbulent. Here's another one, summer of 16. So, we had a crossover here, kind of beginning in June. So this one was here, well before anything got wonky. If we look at, the lows here, you had a little pickup, and then, you get these like exponential spikes here, and that, that's in August, this big drop right here. So we were getting, we had a, kind of the first warning, things are strengthening for state eight, not much going on, kind of, flattish market. You're getting a few spikes, and then wham, the big move. And it kind of carried on like that all the way up until, I would say this would be your flat line. This would be something right here, I think, in this October, where I labeled that first one. One second, Lee, I see your hands raised. This would be, I would think, possibly, where things, right here, that would be, I would probably at this point say, okay, we're clear. As far as, the new lows. So it did move up from there, but you can see it never did confirm with a cross here. So, that as things started picking up again, you just have to be mindful of, okay, it's been pretty good here, then you get spike, and then the aids start working their way back up. So that, I think that would be an indication, but obviously hindsight's 2020. The ultimate flat line was over here, over at the end of February here, and you can see here that's a definite flat line. Okay, Lee, you had a question? Hey, Lee, you there? All right, I think there's Yeah, this is apparently Lee's microphone's not working. Gail asked question, what's this count over here on the y-axis? This is number of stocks. So you had, new lows peaking at like 2,000 here. So really, let's look at spring 2010. Now I pulled this up because this, and I'll annotate it here. This was the other 72, percent in state one. The only other data point we have that high. Obviously this one made higher at 73 something, but this was 72, like point whatever. So from there, you can see things went straight down as far as the state ones, but as we'll see here, that's the 72% I marked right there. Things got choppy, and then wham, it got really hit. And then you had the crossover. So the market pulse crossover didn't happen until well after, because it was so elevated. Normally we're in this kind of range, for the peaks, this kind of range. So we were, 30% higher than the previous time. So, this one just, I think caught a lot of people off guard. We're so overbought, when does it end, things like that. And, the crossover was almost, pretty, it obviously wasn't a good market for the next few months there. But that wasn't a good indication. Now the lows spiked right after May 5th. So that would be right here too. So there wasn't much warning from that 72%. This would be that big spike day that you see on the new lows. So this one, I think I would just chalk this one up to, a shock to the market here. Because, it's pretty much flatlined, and then just one, pretty much one day, it just went way higher. And then that from there, it wasn't good until September. And then, things were kind of choppy here. You had crosses, things like that. But that September, basically in here is that, kind of flat line that I see as far as that. But this one really didn't have a warning other than, we were super overbought on the market pulse. So that's the gist of it. Hopefully you guys found that helpful. So where are we at right now? So, obviously we hit that 73 up here, last week. It's come down to 62. The market dropped a little bit. It's creeping back. But, the other thing we want to look at is, we're dead flat lines on these new lows too. So, that's obviously telling us something totally different than everything else. But, just like my gut, if we look at like VIX, right? Like VIX normally comes down to the low teens, 12, something like that. Since this, pandemic started, let me see if I can pull out a longer term. So since this pandemic started, we haven't gotten down to, like the low level flat line, right? This is, 12. You go over here, it's well below, it's usually 12. I think the low over here is like 20. You can kind of see that 20 line. So something's priced in the market, something. Or else, if we're back in the, flat line type thing, which has been as far as the lows, the VIX would also be flat line, but something else there's some price in it. That's just, what this is telling me, the VIX, you know, we kind of look at all different types of things. Um, so that's kind of, you know, the tools I wanted to show you as far as analysis. You know, we got a little VIX spike. You know, it's not going to go below 20 at this point until, you know, the market's really normalize. But something's priced in. I don't know exactly what. But all right, so I'll open up to questions if you guys find that useful.
Yeah, Josh, where do you get the new lows in the software, or did you do that specially?
No, it's not. It's not just special for me, although I am special.
Yeah,
It's under stocks, the market pulse. So, you know, at the very bottom, you know, so we have like current states. That's the number. We have the transitions, and then I like to use this chart here, the current state percentages, and you know, it'll come up and populate them all, and I just remove, you know, the other states. I just look at 1/8 for the most part. But right below that's the new highs, new lows. So I just pull out the highs. I mean, I didn't really ever get much from the highs, but the lows, as far as you know, trying to see when things, they seem to be a lot more telling.
yeah, okay.
Mhm.
Yep, thanks.
Sure.
Hey, Josh, this is
Hey, Russ.
Russ.
Yep.
As far as which industry or sectors are affected the most on each one?
We don't, you know, what we're going to do is build out a market pulse for each sector eventually. So we'll take all the stocks and, you know, technology, all the stocks and, you know, healthcare, banking, all that, and kind of break them up so that we'll have eventually like a sector analysis where you can, you know, do the different tabs. This is just pure total market, everything we got. All 4,000 symbols. So, so that's, you know, what this data is showing you here.
Okay, understood.
Mm-hmm. Any other questions or comments on market?
Well, this is Dave, and I was just going to comment on your why is VIX not going below 20 kind of question there.
Okay. You got a theory? You got a theory?
I got a theory, yeah. Yeah, you know me, I got a theory on anything. You know, you want to talk about it, I'll have a theory on it. I don't know how good the theories are, but you know, I have an opinion. But anyway, on that one, I tend to think it's the COVID-19 thing is like we still don't know where we are. We're kind of like grappling through it. I look at the a lot of the earnings and some of the plays that go up and down. It's like we're groping in the dark because we don't know what the outcome is going to be, which is why VIX is above 20 and hasn't come down, even in, you know, when stocks are making all-time highs. It's like, okay, we have vaccines, but are these vaccines going to drive down the positive infection rate or the death rate? Well, we haven't seen that in the numbers, and we likely won't see that in the numbers for a little while. So it's going to be an unknown that hangs out there until we get a sort of a fix on the effectivity of that. And
Yeah.
even when we start to see, well, okay, the numbers are going to change in the right direction, and I certainly hope, and I'm pretty sure everybody else is banking on the fact that it's going to help, you know, suppress this virus. It may not suppress it enough to withdraw the social distancing protocols that are killing a bunch of stocks. So that's, you know, depending upon, you know, whether you have a reopening trade or you know, a stay-at-home trade, you know, those go up and down depending upon the sentiment that the problem's going to hang out longer or it's not.
Mm-hmm.
The market looks ahead at different distances for different kind of things. So depending upon your idea, you have to kind of play that as to, oh, how far is the market looking ahead on, in my case, semiconductors or green energy or things like that. If you're a fast food or restaurant kind of person, you got to think about, well, that might be a different time frame for us to recover from that, but you know, so on. So anyway, the reason why I think we're stuck above 20 until we see changes positive changes in numbers, I don't see it going below 20.
Okay.
And the relief packages are another thing. It's like, well, we haven't seen any stimulus yet, just relief and, giving money to people that haven't lost jobs. That's the other thing that I look at a lot is the jobs, and are we coming back with jobs or not? This Friday is the first of the month jobs report. So that'll be kind of something that I look at this Friday to see if there's a change in that pulse.
Yeah. So you think, that we're not going back to normal on VIX until we're either, back up open normal
Yeah.
society?
I would bet Q3. If you asked me to put money on one, I think we might break 20. I'd say Q3 when we see whether the vaccines are working or not.
Yeah.
'Cause we don't know.
Yeah, I think I agree with that. I don't think it'll go back until we're, back to normal life here. I don't know when that'll be. I'm not,
Yeah, nobody does.
but yeah. So, okay. Thanks, Dave. Anyone else? Okay, we'll turn over to the Shawn man, to do his earnings analysis. You there, Shawn?
I am. How you doing?
I'm well. How are you, Shawn?
Good. Yeah, I like that. That's good stuff. I know we talked about that market pulse information, so it's cool to kind of see it. And I think a lot of people can use that to kind of, help them put 2 and 2 together and get a good analysis. So that's pretty cool.
Yeah, I'll post that to the share drive so you guys can have it.
Yeah, cool. All right. Yeah, good deal. Well, thanks everybody for joining. Yeah, I'm going to kind of harp on the earnings trades again, as I do every week, it seems, but I hope nobody's getting too bored of them. But, we do have a lot of trades coming out that have been out, the bullish pre-runners. We're getting into the middle of everything now. So we do have the bullish pre-runners, the, bullish runners. We have the vol crush, the non-movers. So pretty much all across the board on the earnings plan, we have all the variety of trades that are coming to fruition at this particular point in time. If you've been watching, obviously you've been seeing that there still are a handful of, companies that are coming out that, are changing their earnings dates. The earnings dates aren't exactly what they were. So some of the, some of the bullish pre-runners are a little bit harder to get into because some of the dates aren't confirmed or the dates are moving forward instead of backwards. But again, that's just something we're having to deal with now. So, that being said, again, there are quite a few in there. I'm mainly going to focus on the vol crush trades because I really do think there's some great validity in those particular trades. One, based on the risk to reward that you can get when you're doing those trades. Obviously, it's a 4-legged trade. So if you don't have options experience or a decent amount of options experience, the trade itself can be a little daunting, but don't let that get past you. Use the virtual portfolio and the platform to test it before you put them in there, just to make sure you're certain with what you're doing. But there are a couple of examples that are great examples that I want to show you over the past, week or so, and then some that had come out last night and for trading yesterday, and then last night earnings. I think that are just a good indication of why we're doing certain things that we're doing with this particular trade. So, make sure we're looking at the earnings plan. You can see there's a handful coming out or have already been out, 2122 for the vol crush trades, Google, Amazon, Alibaba. So some big names, kind of in the middle of everything right now. So I want to show you some ideas on those and what we've been talking about. So if I go in, and I've been using the virtual portfolio quite a bit, and I would, again, advise everyone to do so. I've been doing it for a couple of different reasons, which is pretty interesting. And I'll show you what I've been doing. I want to go back and look at the Netflix trade real quick, though. We talked about this last Wednesday, and I want to kind of show you the end result and kind of how everything played out. So we talked about, putting the Netflix trade on for the earnings. It was 119 is when they had earnings after the market closed. And we put in 2 different trades. So we put in a trade for the next Friday's expiration. So 119, a couple of days later, the 122 expiration and the 129 expiration. And we had already seen the 122 expiration had lost, it pretty much had lost max value on the trade because the stock had a big rally right after earnings, and then it just stayed up at that level for the most part for the couple of days. Now we can look at the one for the next week on 129. We spoke that Wednesday, which would have been on the 27th. So on the 29th, the options expired, and you can see that at expiration, the loss on that trade was all the way down to 125 bucks loss. And that was because, you know, Netflix had a pretty decent sell-off. If I click on the iron butterfly here, it'll actually show you the particular graph, like a graphical chart of that decline. So, you know, this is when the trade happened. Earnings is this big gap up. And then you can see all the way after earnings and then through until Friday's expiration, the stock trended down a little bit. And this is the expiration right here. So we didn't get a full reprieve all the way down to break even, but, you know, we did take a little bit of a loss on the trade, but not even close to the loss we would have taken if we traded that same week's expiration. So in my mind, that just offers the validity of using that following week's expiration to help reduce, you know, that potential risk there. Obviously, if Netflix spiked up and just pretty much stayed here or went higher, we'd be talking a different story. But, you know, this one said Netflix trade, you know, is what it is, and you could see those results based on that. So, you know, that just gives that validity for that particular trade there. So I wanted to give you guys an update on that one. You know, another one in similar fashion was I tracked, let me get back to my virtual portfolio. I tracked and I actually traded the Tesla trade as well. What I started to try to do here is actually for this Tesla trade, I put it in as its own little vol crust within the virtual portfolio. But I looked at I put in here under my description. So when I go in there and I actually set up the actual virtual portfolio, I put in this description here, the implied volatility for the options on that particular day. And then the day after earnings, I put the implied volatility there as well. Basically just to kind of give me a reference of what it was prior to earnings and what it was after. So you can see for Tesla on the January 29th options, 220% implied volatility at the money straddle. And then the very next day after the earnings announcement, 70%. So the IV went from 220% to 70%. And that's exactly where you get that volatility crush from. If we did the next week's, the February 5th, you could see 135% implied volatility. The very next day it was 56%. So again, that just shows you that impact of that volatility crush when, you know, the earnings are pretty much, you know, kind of flat or mediocre, or the market doesn't really make a big move like it did on Netflix. So these two positions I closed out because they were profitable the very next day. So what you see is in that, like I said, in that implied volatility, that volatility crush came out. So, you know, took the trade off. We're gunning for that, you know, 30 to 40% or 15 to 40% profit, you know, on that trade if we can do it. But if you get that big volatility crush in those options, you know, my thinking is you got to pull that trade off because that's really what this particular trade is about. So you can see the earnings, the entry trade was 127. So I believe the earnings was that evening on 127. Let me just pull that up to verify real quick. Give me 1 second, sorry. For Tesla, it was on 127 that night. So we entered the trade on 127 before the close, and this was the particular setup that we had. So it was about $100 expected move on the trade. Now you can see that for I can actually go back on that day to show you, but we can see that for the options that expired that same Friday, a couple days later, we basically collected a $6,200 credit. $6,200 we collected a credit. And then for the options that expired the following Friday on 2/5, we collected $7,300 and change. So obviously if we're selling a position with 2 days on it, we're going to get less of a credit than we are for options that we're selling that have 7 trading days on it. So that's why we're seeing more of a credit for the 2/5. Now, obviously, if the trade comes off the very next day, as Tesla did, Tesla had a little bit of a move after earnings, but nothing to a huge extent, definitely not the $100 for the expected move. So the trade was closed the next day, and you can see that the trade that had the options expiring that Friday, you know, I made $1,600. I was able to keep $1,600 of the $6,200 credit that I received, versus the following week, I only was able to keep $1,245 of the $7,000. So my profit, you can see my return on risk, 26.65% on that week's expiration versus 16.96 on the following week. And obviously, you can see how that relates to the amount of credit or the amount of risk that you're getting, right? If you're choosing to take less of a risk because you're giving more time for the options to trade out or the stock to trade out if it does have a big spike up or a big spike down, you're giving up that potential profit as well. So not potential profit here by the credit that I receive, but the potential profit on if I get it, if all things being equal and I get out both of the trades the next day, I'm going to probably not take as much of a profit on the one because the options still have, 6 or so trading days left. So, but that's fine. I think as we had seen with that Netflix trade, I'm much more willing to kind of spread out that risk, not take as much risk on the front and give up a little bit profit versus taking that big hit if for some reason I'm wrong and, Netflix gets over 100 million subscribers or whatever they did. So you can see this Tesla trade shows it perfectly. Getting out the next day, you don't take as much profit, but like we talked about before, we're kind of minimizing a little bit of that risk as well. So that's the Tesla one. There was another one that I wanted to talk about. So Alibaba was another one that had earnings just come out the other day. Similar fashion for that particular trade. This trade, when did they have earnings come out? I think on, what is today? Wednesday, Monday night? Is that when they had earnings, I think? Let me see, I'm sorry. So Alibaba had earnings before market open on the 2nd. So yesterday before market open, they had their earnings come out. So this trade right here should be closed because they'll be using yesterday's closing prices. Still open, but you can see another setup for a similar type of scenario here. 2/12 expiration versus this week's expiration. You can see my credit values are a little bit different as well as we'd expect, but then getting out the very next day of the trade because we were profitable on this trade, getting out, experiencing that vol crush. The options that expire this week, I was able to keep 657. The options that expire next week, only 504. So you can see the difference, and just like in the Tesla, with the amount of time that you have on the options. I don't mean to harp on that, but that is a pretty key factor that I want you to be aware of, because the worst thing is to getting into a trade, things work out perfectly as you thought they would, and then when you get out, you're not taking as much profit as you thought. So that's definitely a key factor that you want to be aware of, and that's the beauty about using the virtual portfolios. You can kind of see this in numbers, and then you kind of know what to expect when that trade comes out. I wanted to show you here for the description. You can see February 5th, when I put the trade on, so on the 1st, I did the trade. So you can see the February 5th options had a 62% implied volatility for at the money straddle, February 12th, 49. And then the very next day, 45 and 39 respectively. So it didn't drop a huge amount, but we did get, if you're talking 62 to 45, what is that? That's roughly 30% drop, or maybe roughly around that, 30% drop in the volatility or the implied volatility. So that's what we're looking for. I mean, that's what you want to see in those options. Other than that, let me see real quick. We got a couple. So we had a couple today, Netflix, Tesla, Bottle. So we had a couple that had earnings come out last night. Google, Amazon were two that had earnings come out that were on the volatility crush side. And then we had Chipotle, but Chipotle was on as a non-mover. So I want to show you the differences between those two, and I want to kind of give you an idea of my reasoning behind liking these particular trades versus some of the others, is because, I don't watch that much news, but I do read some news when it comes across my screen or if I hear something. And many people have been talking about, Google was just going to blow through it and they were going to have really good earnings and the stock was just going to make this big rally. And you hear that and you're like, well, are they really going to do that? I don't know. So you kind of take that with a grain of salt. And then, Amazon had a big quarter Amazon, had a really big quarter last quarter. Everybody was buying from Amazon because of COVID and they weren't really going out. So were they going to have another massive quarter? What was going to happen with them? And then Chipotle was another one, right? Chipotle had come out with their new cauliflower rice that you could add to your bowl. So that news shot Chipotle's stock up pretty high. So, that was just recent. So that probably wasn't going to affect their earnings too much, but maybe that was going to give them some further guidance down the road. So all those factors are in there, and you're trying to kind of digest all that information regarding the news. But what you really need to think about with the volatility crush trades is that's just going to add, in my mind, more volatility, more premium to those options that I'm looking to sell. So really, I shouldn't care too much about those particular news, the news that's coming out such as that. So, that being said, if you put the Amazon trade on and then you put the Google trade on, we can see these trades are showing zero because I put these trades on in the virtual portfolio last night. Earnings was last night as well. So then the close of business today is when these trades will be closed, or you'll be able to look at these in more detail. But we can see the Amazon trade had a pretty huge expected move. I mean, the expected move on Amazon, we're talking about 33.80 to 35.80. So almost a $200 expected move in either direction for Amazon. So my credit was $13.95, almost $14,000 for my credit. So we can see the difference between the spread, which is $200, and my credit, which was $14. My risk, is actually going to be $6,000. $600 or $6,000 is my max risk on this particular trade. So pretty decent amount of risk for myself and for most people on this call, but this is something that I think is pretty important to show you guys, because we can see my credit again, $14,000. Amazon, I think they had fairly good earnings, everything being equal. I mean, they made the most last quarter I think that they've ever made, or they broke that $100 billion mark. But then, Jeff Bezos come out and said he's going to be, stepping back in the Q3. So, that being said, the stock right now, Amazon right now is up $7, only $7 in comparison to a $200 expected move. It did have a pretty choppy morning this morning. So, I think it went as low as about 33.40, when it's high today as about 34.70. On the overnight, it went a little bit higher than that after the announcement, but that's to be expected. So, the point is you have all these great factors coming into play for Amazon, but, risk versus reward on this trade, and being able to collect all that volatility crush or that volatility in those options just makes for a great trade. I think that trade right now, so this exact trade here, I'm looking at it on another system. If I pull up the current bid ask or the current on that trade, let me see, what am I, 33.80? That's the 12th, right? So 33.80 and 35.80. Excuse me for one second, I had a different one in there. 35.80 and 31.80. So that exact trade currently right now, mid price, we're looking at 104. So, so you're looking at $10,400, and you would have sold it yesterday almost at $14,000. So within, roughly 12 hour, not even, a little more than 12 hours, you're looking at almost a $4,000 profit on that trade based on that volatility coming out of those options, and trading a stock that obviously everybody's probably using right now because of, not going out and shopping as much. So wanted to show you that example. I'll have this one updated for you next week. Google's another one. Google is on the complete opposite side of that spectrum. So Google had earnings come out. They blew the earnings like everybody, or a lot of people were talking about them doing. But Google is currently trading at 2088. So if you look at this option here, this 2020 is the option that we're using as protection on the upside. The stock traded and blew way past that at 2090 right now, actually 2090. So, one good example to look at this trade 212 versus the options that expire on 25 is the 25 options that expire this week. The trade is going for, let me see. So this is a $100 spread. You can see the difference, $100 max risk, but I'm collecting 7,100. So, I'm collecting 710 when you're looking at it that way. But anyways, $100 is the max loss on this trade. And the February 5th options that expire this Friday, they're currently going for $96, $96.55. So there's only $3.50 left that I can lose if I hold on to that trade till Friday and just hope that, Google comes back down below 2020. But if you look at the options that expire on 212, which are these options here, the trade is going for about $87. So $1,300 or $13 or $1,300 left for my risk. So you can see the one blew through it. I'm almost at a max loss, but the other one for next Friday, I actually still have about $1,300 worth of risk on the table, essentially, with that trade. And then if Google does come back down over the next 7 days or so, I can make some of that money back as well. So, Google kind of shows you the opposite end of the spectrum of Amazon, because Google did make a big move, kind of similar to Netflix. I hate to say it, but that being said, that kind of shows you the two different trades and the validity, I think, of setting it up with that 212. Chipotle is another one. So Chipotle come on as a non-mover. So we're basically using it in that non-mover category. I show it here and we can see Chipotle. So with the Chipotle ones as the non-mover, I'm using 10% as my expected move. I'm using 10% as the sell on my wings, 10% of the price of the stock. So on this Chipotle, when I put the trade on yesterday, 15.25 was the at the money straddle. The stock actually moved dramatically, I believe, towards the close, so that adjusted that quite a bit. But I'm using 10%. So 10% times, 152 is about, let's just say, 150 bucks. So I'm using, roughly 150 bucks to buy my outside wings. I hope that makes sense to everybody. But you can use a screener within Delphian to tell you, if a stock doesn't move outside of a certain percentage, and as long as that stock typically stayed within that percentage range after earnings, then you can use that to build your wings. You don't have to use the expected move. You can actually use that percentage move. And we've talked about that before because we do that on some of these movers or non-movers when we're running that analysis. So 15.25, and I used the wings 16.70 and 13.80 on Chipotle. I collected roughly the 84.85 was my credit. Chipotle was another one that, again, I wasn't too sure what it was going to do, but we could see that Chipotle actually stayed. I'm going to pull it up somewhere else, but Chipotle is down about $35 at 14.89. So you can see it's down to 14.89 from the 15.25. So what is that? 25 plus 11. So we're talking 36 bucks. So it dropped about 36 bucks off of the $150 that I gave it as my guide on each side. So this trade here, 84.85. I'm just using a simulator on another screen, but that trade there, let me see, is going for roughly 64.10 right now. So that's another one that's about a $2,300 trade over the course of 16 or 17 hours or whatever. From yesterday's close to today. So, that being said, obviously Netflix, Google didn't work out so well. They both worked out fairly flat if you held them till the second week's expiration, which is the proper way to do it based on what we've seen with this analysis. But when you're looking at like Chipotle, Amazon and Alibaba and Tesla, those three trades make up a huge percentage of the money that you would have been flat or even lost on some of those other trades. A lot of them are really big trades. We're talking about an Amazon trade, which, that expected move is, plus 200 bucks. Pretty big amount of risk to have on a trade for anybody, I think within this group and definitely for me. But, you can see the validity in these vol crush trades when you're doing that, especially when you can hear all the noise in the market talking about different news events, different things that might happen. And when you do have somebody like Amazon that blows the earnings out, but then they still are fairly flat to down. You're like, okay, well, I would have expected to buy some calls there and just made a ton of money, but that's not the case. This volatility crush happening is in my mind a real thing, and you can see it. You can see it in some of these numbers when we're taking in that implied volatility, and you can definitely see it when you're getting these values of these options drop here as well. So, I wanted to show you those trades. I got a bunch of other ones, from what we've been doing with the bullish pre-runners and with all these different scenarios that I've been setting up. So I'm trying to get all this organized for everyone so we can see it. We can see a lot of these ones from beginning of the year that were making really good monies on these bullish pre-runners. Some of them, I'm looking at some of these now that are only confirmed after 126. I'm starting to put these in there as a separate group. So I'm going to have all this for everybody. I would, recommend if you're following or just tracking these trades to test them out, put them in this virtual portfolio like that. Put them in here like you're going to trade, Tesla. Put it in here as its own category, vol crush. Put in your implied volatility so you can track those implied volatilities and say, why didn't the stock move down or why didn't the option prices move down as much? Maybe the implied volatility stayed high, or why did it make, that much money? Maybe the implied volatility dropped substantially. So putting this information in here and keeping track of it, let Delphian hold the data for you, but you just have to input it in there. But once you input it in there, you're good to go, and you can kind of go back and look at it at a later time. So I think this is a really useful tool. Mine's obviously a little disorganized to the eye. But again, I'm trying to get all this stuff situated. So, you know, if you have any questions and you want to learn how to put these in the virtual portfolio, or maybe use the virtual portfolio in a way that might benefit you, please feel free to contact me or Josh, and I'll get you set up with it and see if we can get you help, you know, on doing that. I think tracking them and paper trading them is the way to go, especially some of these ones like, even like, you know, like the Netflix or the Tesla, you know, the Alibaba, those ones are really expensive. So, you know, I don't think you should just jump right into those if you don't have any experience. But, you know, that being said, be prepared. We do have some really great companies coming up. You know, you have Walmart, I think is one that is coming up pretty soon, probably in a couple of weeks, that I think based on the analysis that we've done, you know, would be some great trades that you might want to go in there and track them and see if that's the type of trading that you like to do. Let me see. This is my vol crush list here. Let me see. I thought I had it organized. This is a different one. But we do have some that are like, trying to find them, sorry. Maybe McDonald's is already done, but you can see like a Walmart here. You know, this Walmart's a pretty good one, 80%. That one's coming up a little bit later down the road. This, you know, Medtronic is another one, 90%. So there's a couple one. Medtronic has a pretty decent expected move. Actually, it's not. I'm sorry. I was looking at the price. $7-8 for expected move. Walmart, you're talking about $10. So those are some pretty, you know, and these are looking at the monthly options. So I think the weekly options for that week after earnings is going to be a little bit less than the $10 or $11. But those are some really good ones that you might want to sort out. And if you don't trade them, I would recommend you track them so we can kind of follow them. And then that'll hopefully lead you to, you know, have some questions that you can ask me, and we can maybe get you set up for the next quarter, or, you know, get you more confidence in trading those particular trades. So any questions from anyone? I see one that Lee said, Lee asked, what's the win percentage of the vol crush trade? The win percentage, excuse me, that I put in for this last one that we used here is I put in 15%. Let me see. We were working something a little bit bigger the previous earnings, but I think that 40% was being a little too aggressive because that was coming from another group that we had been in before a couple of years back. But when I tested these vol crush trades for this one, looking at a profit percentage is 15%. So that being said, like on a trade like that Amazon, if I collect, let's just say $10,000 on a credit for Amazon, I'd be looking to get out and keep about $1,500 of that $10,000 the very next day. You know, you can test it and be a little more aggressive if you want, but I think the fact that we've changed to using the following week expiration, we have to be prepared to drop a little bit of our potential profit down. And that being said, that 15% seems to be a great level for us. Again, you can always adjust it and make adjustments to these profit target percentages for yourself. And if you find some that work better than the 15, then great. You know, as long as you have the analysis to back it up, I would say, you know, put it in plan, so put it in place. So let's see. Okay, and Lee, were you asking more about the win percentage? I'm sorry, yeah, I said the profit percentage. I'm sorry, you're talking about the win percentage of the vol crush trades as a whole? Oh, okay, yeah. So yeah, he's talking about the win. I don't have that as of yet, but let me see if I can get that together by the end of the week. And if I do, I will see if we can put that out either in an email to everyone so you can kind of see it. We don't have tons of them. Let me see, I'm trying to get over to these trades, all trades. As for the vol crush trades themselves, if you're looking at this list here, we have roughly 38. The red ones we didn't do because they didn't meet the profit factor criteria, but we're looking at about 38 of them. So those are definitely going to be a little bit easier for me to get those numbers for you. So let me get back to you on that. Those bullish pre-runners, we have, you know, 150 plus or so, with some not confirmed. So those are a little more tricky. But I should be able to get you the current vol crush ones pretty quickly. Let me try to get it done. You know, once this week goes through, once we get the rest of these trades done and any others that might be coming out today or tomorrow, I'll see if I can get that results for you by, you know, for Q4 2020 start up until this Friday, which would be the 5th. So let me get that together for you.
Hey, Shawn, this is Russ. When you're saying the following week, is it regardless of when the earnings is, Friday versus Tuesday, or are you always saying the following week regardless?
That's what we've been doing with these. We've been doing the following week regardless, and I think that's going to be crucial. Some of the other ones, I mean, you could test it to try to make a case like a Walmart that might be an expected move of $3 if it comes out on Monday, doing that Friday's expiration. If you can test it and it shows, you know, similar results, because Walmart probably doesn't move that much, you could probably use that Friday's expiration. But just make sure you're testing it. I've been using the following week's expiration for probably 99% of all mine, just to help me kind of minimize some of that risk. And two, we have a decent, you know, you have a decent amount of volatility, I think, in the market. You know, the VIX is down, like Josh and David spoke about earlier, down to some levels, but, you know, I think there's still quite a bit of uncertainty in my mind. So using that following week just helps me kind of mitigate, or at least kind of spread out that risk a little bit. But yeah, I feel with some of these, like a Walmart, like we're talking about here, you know, that's going to be one that you just are going to want to test, because 2/16, I don't know if that date's confirmed on 2/16, but 2/16 would be a Tuesday. So we'd have to look at the expected move. But for all intents and purposes, I would still use the following week, the 26th, as expiration for those options. Again, your profit is going to be lower if you get out the very next day, but you're still going to make a profit on the trade, and you help reduce your risk, in my mind, substantially. So I think it's a no-brainer to do that. And that being said, you know, if you can see the data, if you can see that implied volatility come out of those options, and you didn't hit that 15% profit the next day, but the volatility did come out, and you're profitable on the trade, take the trade off, take the profit, and move on to the other trade. If it's a trade like Google, to where you're pretty much near max loss, you know, but you still have 6 or so days on the trade, in my mind, holding that trade offers more of a benefit than getting out and just saying, okay, well, I could either gain back, you know, $5,000, or I could give up and lose maybe another $300. Which one would I rather do? Well, I'd rather try to gain back another $5,000 or $6,000 over the next 6 days. So, you know, that being said, on trades like that, the Google, the Netflix, it seems more prudent to hold it and see if you can get a little bit of reprieve in the market, if it can come back to the mean. But, you know, if you're getting that vol crush, it happened after earnings, vol crush happened, stock pretty much did what was expected to do. If you're profitable, maybe not 15%, but maybe 10%, I mean, there's really not much of a reason not to take the trade off at that point. The volatility crush happened. That's the design of the trade. Take the profit, move on, and learn, and see if we can improve it next time.
Hey, Shawn,
Fair.
this is Dave. I kind of have an experience might relay here that might help in trade management on at least in one particular example here. I did the SWAX 1 week and 2 week, kind of like you were doing with Amazon there. Sorry, SWAX is Skyworks. It came out on Wednesday. So I did, well, it's Wednesday, should do the one Friday or the following Friday. So I did both. And so here's what happened is Skyworks came out and beat handily, went way outside the expected move. So I was at max loss, right? On the first day out, it was a screamer. And then Friday, if you remember, was a risk on day for everything. Bonds, stocks, everything was down on Friday. It was everybody was risk on for, I'm not sure what the reason was but there was a good reason for it on Friday. And so the first week trade actually came in, it was on Friday, it was between the strikes, closer to the short strike than the long strike on the call side. So it was my chance to be able to, well, I can get out here. I put a closing trade in to get out. And I think I even get a few pennies. So I got out without getting scathed on the first week because it was a risk on day and everything was coming down. Just happened to bring my the call side back into in frame there. And so I figured, okay, great. They saved a few, maybe I think I made a few pennies or a couple of bucks, but not anything to scream about there. And I was happy to get out of that trade because it had gone right against me big time on the first day after earnings were released. Then on Monday, I figured, well, I didn't close out the second week trade on the first Friday like I did the first one. I kept it on. I figured reversion would continue and I'd probably end up getting, a better result. It turned out not to be the case because Monday was a risk on day. And so it blew right back through. And so I'm not in a great enviable position right now, but it's been coming down the past couple of days. So I guess the reason I even bring this up is pay attention to what the whole market is doing on the days of, the Fridays on your expiration days, and factor that into whether to, especially when you have this 2-week iron fly on, factor that into where, how that could impact your next week. And
Right.
It's like a common sense thing if you think about it. A lot of times we're just, looking at market maker moves and a lot of technical stuff, and we forget about common sense. But the whole market does affect things as well as your earnings plays within the whole market. So take that into consideration when it's a big risk on or risk off day. It could help you out. And just saying.
Right. Yeah, I agree, and I think with it blasting through, that's where I think, and I kind of hope that keeping track of these implied volatility numbers for some of these bigger ones, like the Teslas and keeping the track of these implied volatilities and saying, okay, did they move in my favor? Did they not? And if they did, then I probably should be out of the trade, right? I mean, that's what I'm trading here. And like you said, once that comes back to fruition and that implied volatility is probably down of those options, probably best to just bail on both of the trades, right? I mean, that's kind of what you were in there for. So yeah, sometimes that volatility from other places in the market could definitely adversely impact the trade that you're in my mind as well. So, and that's what I was going to show you too with this one. So with that Netflix, I was talking about it with Josh today, this morning, is with this Netflix trade here. You can see the one that was just a minimal loss for the following week. I had a similar setup where this particular thing this day happened here, and I could have probably got out of this trade for a bit of a profit. But with this big move down, I said, well, that looks like the market might kind of continue this little trend down. And then sure enough, the next day it spiked up, and then I went from probably being slightly profitable to, maybe losing 100 or so bucks. But either way, once this happens, you kind of gotta not adjust your plan, have a plan for what you're going to do if this does happen, but be prepared to, if it does come down, do you get out, or are you trying to hold for a couple of days? Know exactly what you want to do before it happens, so you can be confident in what you're doing and making the right choice. But yeah, market as a whole, I think, and other companies too, right? If you're trading, Walmart and Target has earnings the next day, that could affect the value of those Walmart options, right? That could affect the value of that Walmart stock. Or, if you're trading, NIO and Tesla does something, then that definitely could affect the value of NIO or Tesla adversely. And the next thing you know, something you didn't foresee happening could easily happen in those particular markets based on other particular companies within that sector making some big changes as well. So I think, yeah, one thing I did want to mention too is that if if the volatility crush happens and the trade is what it is, and you're able to take the profit on the trade, one in particular would be, as an example, would be Tesla. I got out of Tesla because that's what the trade was. I got the implied volatility, I got the vol crush, so get out. I took the profit, like we talked about. It was above the 15% versus my risk just by happenstance. But if it wasn't, I would still get out because the volatility crush happened. But if you look at real quick, these options that were going to expire, this Friday, they're 880s, and the stock on Tesla went up to 875, I think, yesterday. So you could see the value of this trade. I got out for around 50, right around 50 something bucks, or no, I'm sorry, like 60 bucks. The value of this trade now, which still would be a valid trade based on the expiration, is worth about $34. So that's almost another $3,000 profit that could have been taken off. So, holding these trades, you can see, oh, great, I would have made more money, but that's not always going to be the case. So always take into effect this volatility crush. This is what we're trading here. You can always make or lose more money if you kind of look at it in hindsight, but have a plan, stick to the plan, and use Delphian, with some of these analyses. And in my mind, for these vol crush trades and those non-movers, you'll be profitable. So, any questions, anyone? I know I'm a little long-winded. Sorry.
Shawn, I got a question. Just an observation. If you're looking to do iron butterfly on a option that is like the one that's up here, you have the option that you're entering date is pretty close to the expiration.
Right.
So I'm thinking price wise, the extrinsic value is already starting to go down because it's close to expiration. So it would be a cheaper option than if you were buying, let's say it was expiring farther out in time. Wouldn't that the options would be much more expensive, which means your credit would be much more, you'd get much more of a credit, correct?
Yeah, you can see for these, because if you just compare these two here, you can see the 880s for that week expiration, 31 and 47 respectively.
Yeah.
Up here, 47 and 63 respectively. So 16 bucks more on that side, and roughly 16 on that side. And then the options that I'm buying for protection, this call option 980, 763. This call option 980 is $20. So you can see there's a huge difference in value because I'm going out another week's worth of trading. So it does, it does decrease. Well, I mean, this one increases you can see it increased my credit a little bit, right? It's almost $1,000, but I'm also giving the market or Tesla another week's worth of time to make some of these crazy sporadic moves. But that's not really what I'm trading. I'm trading the depletion in these two values here. So in theory, it's possible that when these two values deplete here, maybe my further out of the money calls won't lose as much value. So then that might make this option more attractive. I don't know if that's what you were getting at, but
yeah, I was just trying to see if there was some kind of a skew between the farther out expiration versus the closer expiration,
Yeah.
And,
yeah, but I mean, if it does,
I was trying to figure out the relation between the extrinsic value that's left, which would be IV, and if there's a way if there's a way to take all of these candidates for the iron butterfly and screen those just for high IV.
Just for high IV, yeah, and we can screen them. So you can screen within Delphian some of the ones that have the higher implied volatility versus like their relative implied volatility. I haven't figured out the best way to use that analysis to put it on top of these, but that screener is in there. So if you're comfortable using it, go in there and check that one out, because we do have it.
I gotta play around with that one, see what I can come up with.
Because you can take, that list of, this list of how many ever symbols we have. Let's say there's 38 of them, right? So if you take this list of 38 symbols for vol crush, you can save that as a stock list. Come in here so I went into stock screener, custom screener, and then you can go down to these option filters and use this implied volatility, and you can use like the at the money implied versus like your relative. So you can do a bunch of different cool things with this one. And it might help you kind of run some further analysis to see if there is a big gap between current IV versus relative IV in the past. How often does that get crushed versus not? There's a lot of cool things I think you can do. It just takes some time of writing like a roadmap down and performing it within this screener.
Yeah. Okay. Beautiful.
Yeah. So cool. Yeah, definitely use this. I mean, and too, don't get discouraged, right? Because I do this many times to where I come up with something. I'm like, oh, that's totally backwards of what I thought it was going to be. And then I just say, well, let me adjust these numbers or adjust this figure and see. So, you know, it might take some trial and error to do it, but it's a great tool to use for sure. So,
Well, even if you come up with a different thing than you thought, it's still a learning tool, you know, and you
Right.
can kind of
That's
tweak
right.
it from there, you know.
that's right. And that's why I think keeping track of these within your virtual portfolio, or keeping track of them somewhere else when you can keep track of those IVs versus the relative IVs in real time, I think it kind of helps you go back and say, okay, last year or last quarter, it was 220 IV versus, you know, 60. Now it's 330 today. Let's see what it is tomorrow. And you can maybe kind of put some more numbers together that way too. So.
Yeah, I like that idea. Yep.
Cool. And then Anita had mentioned, you know, looking at some of these post-earnings trades. So I think there's some really great, I don't have many in my virtual portfolio yet to show anyone because not many have started coming out, but they are starting to come out now. But these post-earnings trades are some really good trades. I mean, you can see the validity in people wanting to buy certain companies based on, you know, when they have earnings come out. You know, Alibaba's one that had come up as, you know, our bullish runner. You can see right here, Alibaba, you know, bullish runner. I look at some things, I look a little bit deeper onto some of these, and, you know, other people might want to do something similar as well. Alibaba is a little bit harder because it is a Chinese stock, so it seems a little bit more difficult to get some data from. But, you know, Alibaba, they had their earnings posted as 2.76 estimated, but they don't have a confirmed on this other system. But I will try to look at to say, okay, well, you know, let's say something like MCK, McKesson is one. So McKesson, you know, they had earnings come out last 2/20. They don't have some. Oh, they do have some. I'm sorry. So they had earnings come out 6 a.m. on 2/2 yesterday morning. Earnings estimated was 4.13, and their actual earnings was 4.6. So not a big disparity between like an earnings surprise. You know, we're talking maybe 50 cents. But I'll look at that, and if there's a huge disparity between that number, the estimated versus the actual, you know, that might help more validity to these bullish pre-runner trades. So that might say, maybe I'll pick the McKesson over the BABA just because of that fact. But I think you can look at different areas based on those numbers and see if one's going to offer you a potential, you know, better analysis than the other. All of these trades, we've screened them, you know, using the screeners that we have listed within that shared file section. But you know, there's going to be a lot of great trades here for these bullish runners, and then obviously don't forget to look at those bearish runners as well. So, you know, if we're getting into this market that's a little top heavy, you know, some of those might start proving fruitful because if we get a little bit of a pullback in the market. But you know, again, you can kind of see bullish runner, Humana. You know, you're talking about a line. So some pretty decent companies in this environment that might be fairly bullish. But, you know, and then these bullish runners. So you're going to let the trade, let the earnings play out. You know, if earnings is last night for Chipotle, and then today would be the earnings day when the market's going to react to the earnings, your bullish runners or your bearish runners, you would want to execute that trade the following day. So that would be executed for Chipotle. It would be executed tomorrow because you're kind of letting the earnings day and the madness of earnings happen, and then you're trading it the next day. So. Anita, once I get some more numbers on these bullish runners or bearish runners, I'll provide that to you as well. So I'm in the works now of getting all of this up to date on these earnings trades. So I'm hoping to have, you know, kind of an update for everyone, but it is taking me a little bit of time, so I apologize for that. But once we get that done, I'll make sure we get it out to you guys. So two things definitely on my list. By the end of the week, I want to see if I can get the up to the date vol crush trades. You know, the win percentages, how many trades we did, how many were profitable, and more of the analysis on those for you guys. And then I'll see about some of these after post trades as well, these bullish runners or bearish runners, and see if I can get just some data on those. Any other questions, guys?
Comment for you on the bullish runners post earnings, and I agree. I've had significant good luck with those, maybe even more so than the flies. But to your comment about doing it the next day, I would say don't do it first thing the next day. I would wait till like after 10:30 or midday and look to see, during the earnings day or the night of, you'll either have a lot of analysts that'll come out and make a change the call or make a call, and that'll help you. With your post earnings play too. So, give you a chance to, hear the news of what other people are going to say for the first hour or two, I would say, on the bullish runners on the day after earnings.
Yeah.
I think you get a lot of good news that way, and it'll help you try to surmise the magnitude, and you should at least know the direction after that. So.
Yeah, and that's fair. And using some personal analysis like that, I think, is great. Hopefully that can only help you kind of solidify some of these results. I mean, these fields, we've back tested them for the past 10 plus quarters, so we have the data based on the analysis of those past quarters. So the data is what it is. But maybe some of that external data, if you want to add that in there, and I typically will do that in a situation like this here. I have 1, 2, 3, 4, 5, 6, 7, 8 on this page that are just for 2/5. So February 5th, 8 different trades for a bullish runner on 2/5. Now, I would love to be able to do all those, but I don't think that's probably the most optimal thing for me to do. So I might take these 8 and say, okay, well, how can I analyze these a little bit deeper to see if I can find the best 3 or the best 2 out of this 8? And, obviously I could pick the 2, and those could be the 2 wrong trades no matter what analysis I did. But, that being said, I try to take some other external factors to say, what is going to make me pick this one over that one? And then if I can find some numbers, great. But, that alone, that we've tested these alone. So, I mean, these testing alone within Delphian, we've come up with some great results. We've thrown out a bunch of symbols and a bunch of results that were fairly mediocre or even average, and we've tried to give you the best of the best. But again, this is great by itself, but if you want to try to see why would you choose that one over that one, maybe you can run some other analysis as well. But yeah, like Dave said, I mean, Google had earnings come out last night. You got everybody under the sun pretty much changing their price targets, whether, they're saying higher or lower or whatever the case may be. But then also you can look at Google and say, okay, well, Google was expected to do, I'm looking at it right now, 15.9 cents or $15.90, and they actually did 22.30. So a pretty decent increase based on those values that was expected. So you could see the validity for the stock to potentially keep going higher. And like Dave mentioned as well, market sentiment. If the NASDAQ takes another big drop like it did, earlier this week, Google is probably going to fall with it as well, right? So that could kind of put a wrench into that trade. But, that being said, I look at those numbers too sometimes to kind of get an idea. So, yeah.
Yeah, I wanted to say something while you got that chart up. Yeah, I see you have Corvos on the top line there. And I was looking at that today too, because earnings are tonight. And it's kind of what I follow anyway. So the thing is, they don't have weeklies on Corvo. So yeah. Monthlies, which is why it's probably not in the pre-runner kind of group. Well, I don't know, maybe it is. But it's definitely a post. Oh, it is pre-runner. Okay.
Yeah, pre-runner, but not like it wouldn't be a mover or a vol crush. Yeah.
Yeah, so you can't really do it for this week. You have to go out to February, which is, I don't know, 14 days or probably 19th, I think it is. Anyway.
Right.
I was kind of wondering how you would analyze that one when it doesn't have weeklies. Can you kind of look at that? Maybe you could. I was having a hard time figuring out exactly how to play that one myself. I haven't yet, but it's.
Yeah, I mean, it's hard. It's hard to put it like in a vol crush category, right? Because you don't have those weekly auctions. I think that's what makes that's what kind of makes that trade what it is, and the ability to be able to get out fairly quickly, because you do have those weeklies and they can lose that value pretty quickly. But like you say, those February options for QRVO, the February 19th, they have 16 days on them. So, right. So basically, if you do get a big move one way or the other, those options still have a decent amount of time on them to where I don't think they're going to, I don't know, but they wouldn't lose as much value as if they had weekly options on them. The implied volatility of those at the monies are almost 60%. So I don't know what that is based on their relative IV or what they typically are. If I look at March is at like 50%. But, you can always test that theory on this one for like a vol crush using the monthly options, test that within Delphian to see if on average it works for QRVO. But since it didn't have those weeklies, I didn't test it based on that vol crush.
Right.
But, you could always test it using a monthly option, just run that test, using the Wizards back test and using the earnings, using vol crush, and then just change your trade strategy on the iron butterfly, change it from weekly to monthly and see. And that's what you're talking about, right, Dave? Using like a vol crush type trade for it.
Right. I actually was going to play it a little differently. I think I was going to sell a kind of like a half fly with a put side, so a wide put spread, and then buy a call spread on that one. It was so I was kind of combining a couple things just because it will follow a lot of the other semiconductors over time that have already reported. So it's
right.
It's kind of just one that I have feelings about, and I kind of think I can play it based upon what others do and or have done, and we'll see. I'll get caught with a big ball, a risk off day or something like that, and that'll hurt me. But we'll see.
Well, let's hope not. Let's hope not. But yeah, the trade designs you're talking about are a little bit different. But yeah, those are all fair trades as well, right? Selling that put spread or selling some type of spread to maybe buy a call spread. those are great trades to employ if you have that bias. And I think you have a pretty good handle on some of those semiconductor, these types of markets. So. And we got enough data I think we have enough data within Delphian to be able to test the strategy like that on that to see, over the past 10 or 14 quarters, how well would it have done if I sold a put spread. And then obviously if the put spread makes money, you could try just a call spread, and then you could kind of put those two together and see what the results would be as a sum, and I don't think that's a bad way to do it. That's what we have Delphian for, right? Is to be able to kind of say, this is what I'm thinking, let me test it real quick. And some might be able to test it in 10 minutes, some it might take 30, but if it's a trade that's going to be profitable, $1,000 to take 30 minutes of your time to test it, I think would be the right thing to do,
Yeah, I think when I looked at it, when I finally made a decision, I picked strikes that were the max gain and max loss were the same. So, if my IV is right, I should do okay, even saying. So we'll see. But that was my thought too, is I'll try to make it so that I'm not lopsided on my win versus loss kind of thing. And implied volatility will come down over time. So I think you said it was going to 60 to 45, I think, over 2 weeks or 16 days, 18 days.
Right.
So we'll see.
Yeah. Yeah. So test it. If you test it, let me know. If I can run a test on it, I will, and see if I can come up with something. But I'm going to see. It doesn't show up as the bullish runner. So I was trying to see if we have it on the bullish runner list, but maybe the results weren't as optimal as what we were using to kind of put out on the list. I don't see it as of yet. Let's see. I have a lot of them on here. That's the raw data. I'm sorry. I guess I wanted to look at that. But yeah, would maybe look at that, because some you can see on the list that show up as a bullish runner. So then you can assume based on that fact that earnings will come out. It could drop or go higher after earnings, but then the day after the earnings trades play out, it typically goes up. But that one doesn't show up on that. That one doesn't show up as a bullish runner. So maybe, I don't know, it might not have just met the profit factor or where the case may be, but I can't tell you exactly. So without testing it and seeing. So, but cool. Anything else, guys? That's all from my part. I hope everybody finds the vol crate, the vol crush trades. They like them. I hope, a lot of people are still using them. Some of those, again, pretty big, Amazon and Google are pretty expensive, but we do have some of those other ones coming out, over the next couple of weeks that are really going to be, in my mind, some great trades for this vol crush strategy. Low risk, but some still good reward, really good profit potential out there. So Thanks, everyone. I appreciate it.
Yeah, thanks, Shawn. Thank you, everyone, for attending.